FHA loans are sold as the easy button for buying a home. Low down payment, flexible credit, simple approval. And all of that is true. But there's a hidden cost buried inside that loan that most people don't fully understand until they're already in. And that could quietly drain tens of thousands of dollars if you don't have a plan. Today, I'm breaking down exactly how FHA mortgages work, what it actually costs on a real loan, and how it compares to conventional loans, and the strategy smart borrowers use to stop paying it. All right, let's go. I'm Matt Jolivet, owner of Associated Mortgage Brokers and a licensed mortgage broker working exclusively in Oregon, Washington, and Idaho for over 26 years. I've helped thousands of buyers work through loan programs like FHA, and I've seen firsthand how the mortgage insurance Pete's catches people off guard. So let's get into exactly how this works. But first, a quick history lesson. And this actually matters. It's 1934, the Great Depression. Banks weren't lending. Most people couldn't afford the down payments required. Foreclosures, they were everywhere. The government created the Federal Housing Administration to fix that. But here's the key thing. FHA doesn't lend you money. Your lender does. FHA insures the loan. That insurance is why lenders will approve borrowers who don't fit the perfect conventional credit box. That's still exactly what FHA is today. It's the flexibility loan. And that flexibility, it comes with a price. Now, before we get into details, let's put some scale on this program so you understand how big of a deal it actually is. 90 years of history. Since 1934, FHA has insured more than 40 million loans. That's 40 million families who got into a home partly because of this program. 790,000 borrowers in 2024 alone. In fiscal year 2024, FHA supported homeownership for over 790,000 Americans. That's a lot of families. About 17% of all purchase loans. In 2024, FHA held roughly a 17% market share of all purchase loan originations by loan count. That means close to 1 in 5 purchase mortgages in this country went through FHA. Compare that to the broader market where first-timers are only about half of all buyers. FHA is genuinely the first-time homebuyer program. One important thing about FHA's market share, FHA does not have a formal target percentage of the market. It's designed to be counter-cyclical, meaning it expands when private lending tightens up and pulls back when conventional credit is freely available. During the pandemic, when conventional lending was easy and rates were low, FHA's share dropped. When credit tightens or rates spike and buyers need the lower bar to qualify, FHA fills the gap. That's the role it was built to play. So how long do most FHA borrowers actually keep the loan? There's no specific data published on this, but the broader picture is useful context. According to Redfin's 2024 housing analysis, the U.S. median homeowner stays in their home about 11.8 years, well short of the 30-year term. For FHA borrowers specifically, that number is probably lower. Most FHA buyers are first-timers who either refinance into conventional once they've built equity and improved their credit, or sell and move up. The point is, most people who take out a 30-year FHA loan are not in it for 30 years, which means the exit strategy we'll talk about later is more realistic than it sounds. All right, now let's get into exactly what FHA looks like today and what it costs. So what does FHA flexibility actually mean in practice? Down payment, as low as 3.5%. Compare that to conventional. First-time buyers can put down as little as 3% on conventional, but without strong credit, the mortgage insurance on that loan can get really expensive really fast. And if you're not a first-time buyer, conventional requires 5% down. FHA's 3.5% is available regardless of whether you've owned before, and the mortgage insurance cost is more predictable across credit score ranges, which is part of why it stays competitive for buyers below that 720 credit threshold. Credit score. FHA allows 3.5% down with a 580 or higher score. Lenders can be stricter than FHA's baseline, and lower scores usually mean higher rates, but FHA can say yes when conventional says no. And here's something worth being direct about. A borrower at a 580 credit score and a borrower at a 680 credit score are getting meaningfully different interest rates on the same loan. That gap adds over time, sometimes more than people expect. If you're close to a higher tier, it might be worth spending a few months improving your score before you apply. Debt to income. FHA typically allows higher debt to income ratios than conventional. Conventional usually caps around 45 to 50% on the debt to income ratio. FHA can go up to 56.99% and in some cases higher with strong compensating factors, things like solid reserves or credit score profile. If you've got student loans or a car payment eating into your monthly income, that higher ceiling matters. Gift funds. Family can help with down payment. That's a real advantage for a lot of buyers. Seller concessions. FHA allows up to 6% of the purchase price in seller concessions. That means in negotiation, you can ask the seller to cover a chunk of your closing costs. In today's market where buyers have more leverage, this is a real tool that can significantly reduce what you need to bring to closing on top of your down payment. Loan limits. FHA has loan limits by county. Before you assume FHA works for your price range, check with your county's current limit first. It varies significantly across the country. Now here's something that surprises a lot of buyers, especially ones who've done a conventional loan before. FHA has a minimum property standard that a conventional loan doesn't require. The home has to pass an FHA appraisal, and that appraisal looks at condition, not just value. Peeling paint, a compromised roof, exposed wiring, safety hazards, any of those can stop an FHA deal cold until they're repaired. On top of that, the appraiser has to be FHA approved. The lender just can't use any appraiser. Your lender will order from the FHA approved roster, and the review is more detailed than the standard conventional appraisal. Now, this doesn't mean you can't only buy a perfect house, but it does mean you need to go with a realistic expectation, especially if you're looking at older homes or fixer-uppers. Your realtor needs to know you're using FHA financing up front, so they're not writing offers on properties that are going to fail the appraisal. So who does FHA help most? FHA works best if you're a first-time homebuyer without a large down payment saved, someone rebuilding their credit after a rough stretch, or someone with solid income but higher monthly debts, or someone who needs to buy now and optimize later. That last one is important. FHA doesn't have to be permanent, but you need a long-term plan going in because the people who get hurt by FHA are the ones who didn't think past the approval. One more thing worth mentioning, FHA allows you to buy up to a 4-unit property as a primary residence, meaning you live in one unit and rent the others. For first-time buyers looking to house hack, that's a compelling strategy on paper. But here's the reality check. 3 and 4-unit properties come with what's called a self-sufficiency test. FHA requires that 75% of the projected rental income from the property covers the entire mortgage payment. The property essentially has to justify itself on paper before you can qualify. It's a higher bar, and a lot of buyers who get excited about the multi-unit angle run into that wall. 2-unit properties don't have the same requirement, which makes them a more realistic entry point for most buyers. Here's the part that most people gloss over in the excitement of getting approved. FHA Mortgage Insurance has 2 pieces. You pay one up front and you pay the other every single month. Let's break them both down with real numbers. The upfront mortgage insurance premium. Upfront MIP is 1.75% of your base loan amount. It's how the FHA mortgage insurance program is funded. Here's how that looks on a real purchase. A $450,000 home with 3.5% down is a base loan of $434,250. 1.75% of that is $7,599. And here's something worth being clear about. This upfront MIP applies regardless of how much you put down. Even if you put down 10% or more, you're still paying that 1.75% at closing. It's a flat cost of using the FHA program. Full stop. Now, most folks, they don't write a check for this at closing. They roll it into the loan, which means your actual loan becomes about $441,849. You're borrowing that cost and paying interest on it for the life of the loan. That's cost number 1. Monthly mortgage insurance. This is the one that really adds up. Every month, on top of principal, interest, taxes, and insurance, you're also paying FHA mortgage insurance. Same example, $441,849 loan, 30-year term, less than 5% down. The annual MIP factor on that scenario is around 0.55%. So 0.55% of $441,849 is about $2,430 a year. Divided by 12, roughly $202 per month. That's $200 extra every month just for the insurance. Over 10 years, about $24,000 out of pocket, not counting the interest on the financed upfront MIP. Now here's where a lot of buyers get blindsided. Most people assume FHA mortgage insurance drop off once they hit 20% equity, like conventional PMI does. It doesn't. If you put less than 10% down, FHA mortgage insurance stays for the life of the loan. You can't just call your lender and ask them to remove it. It doesn't automatically fall off. The only ways to get rid of it are to sell or to refinance out of FHA entirely. If you put 10% or more down, it does drop off after 11 years, but that's a much bigger upfront investment. This is the part of FHA that catches most people off guard years into the loan. They're still paying $200 a month and wondering why. Which brings us to how FHA actually stacks up against conventional. Here's the real world comparison I run for buyers every single day, and it's not what most people expect. When I'm looking at a borrower with a credit score below 720, my first move is to run both FHA and conventional side by side. Even though 720 is a solid score at that level, it's really a mortgage insurance comparison, not just a rate comparison. That monthly payment difference is what tells the story. Here's why. The 720 threshold matters. Above 720, conventional PMI is usually competitive. The borrower hits better rate tiers, conventional PMI drops off automatically at 20% equity, and there's no upfront mortgage insurance premium. Conventional often wins on the total monthly cost. Below 720, conventional pricing gets worse fast. Rate adjustments called LLPAs or loan level price adjustments kick in and drive up either the rate or the cost to buy it down. FHA pricing is more consistent in that credit score range. And the flat 0.55 MIP can actually come out cheaper than what conventional PMI quotes in those tiers. The down payment piece matters too. Conventional PMI cost also depends on how much you put down. Put down 5% with a 680 score in conventional and your PMI can be surprisingly high. FHA, 3.5% down with the same score sometimes produces a lower total monthly payment. The honest answer, there's no universal winner. The right loan depends on your specific credit score, down payment, loan amount, and how long you plan to stay in the home. Anyone who tells you FHA is always better or always worse without running the actual numbers isn't doing their job. Now here's something most people never hear about FHA, and it could actually make your home easier to sell down the road. FHA loans are assumable. That means a future buyer can take over your existing FHA loan, your rate, your balance, your remaining term, instead of taking out a brand new mortgage at whatever rates are doing at that time. In a market where rates are elevated, that's a genuine selling point. If you lock in an FHA loan today and rates are meaningfully higher 5 or 10 years from now, your assumable rate becomes a marketing advantage. Buyers would rather assume your lower rate than start fresh at current market rates. Conventional loans are generally not assumable. This is one of the few areas where FHA has a structural advantage that conventional can't match. It doesn't change the mortgage insurance math, but it's worth factoring into your long-term thinking, especially if you're buying in a rate environment where future buyers might benefit from inheriting your loan. Now, here's one of FHA's most underrated features. If you already have an FHA loan and rates drop, you have access to something called the FHA Streamline Refinance. It's a simplified refinance option designed specifically for existing FHA borrowers. What makes it different? Less documentation than a standard refinance. Often no appraisal is required, faster and cleaner process built to improve your situation without starting over from scratch. Important caveat. A Streamline typically keeps you inside the FHA system. You're still paying mortgage insurance. It's not the move that eliminates it. Think of the Streamline as the middle step. Lower your rate, lower your payment, reduce what you're paying monthly, and use that time to keep building equity and improving your credit profile. The Streamline buys you breathing room. The conventional refinance is the exit. Here's the game plan that actually works. Step 1, run the comparison first. Before you commit to FHA, have your broker run FHA and conventional side by side. If your score is below 720, FHA will often win on monthly payment. Above 720, conventional may surprise you. Know the numbers before you decide. Step 2, make the right down payment decision. If you're close to 10% down, run that scenario too. Putting 10% down means mortgage insurance drops after 11 years instead of lasting the life of the loan. Depending on your loan size and how long you plan to stay, stretching to 10% could save you more than the cash you're holding on to. Step 3, improve your position while you're in. Make extra payments when you can. Let your home value grow. Work on your credit score. Increase your income. Every one of those improves your refinance options. Step 4, pick your move when the math works. If rates drop, the Streamline is a quick win with less hassle. If you've built strong equity and your credit has improved, refinance into a conventional and eliminate mortgage insurance completely. This isn't about predicting where rates go. It's about being financially positioned so that when the opportunity comes, you can take it instead of staying stuck. Here's the bottom line on FHA. This is a program that's been helping families buy homes for 90 years and has backed over 40 million loans. Last year alone, it helped nearly 800,000 Americans get into a home. For the right buyer, it's absolutely the right call. But go in with your eyes open. You pay 1.75% upfront, usually rolled into the loan. You pay monthly mortgage insurance that adds roughly $200 or more to your payment depending on loan size. If you put less than 10% down, it doesn't drop off until you refinance or sell. FHA appraisals are stricter. The property has to meet minimum condition standards and use an FHA approved appraiser. Multi-unit properties have an additional self-sufficiency hurdle you need to plan for. Below 720 credit score, FHA often beats conventional on all monthly payments. But run the numbers. Don't assume. And FHA loans are assumable, which is a long-term advantage conventional loans don't have. Most FHA borrowers don't stay in their loan for 30 years. The average homeowner moves or refinances around the 12-year mark. That means the exit strategy isn't some distant hypothetical. It's something you should be planning for from day one. If you want to see a real side-by-side dollar comparison of FHA versus conventional over 5 years, drop a comment below. And the numbers, they may surprise you. And if you're in Oregon, Washington, or Idaho, use the link in the description to schedule a no-obligation strategy session with me. Subscribe if you want the real math on mortgages, not the sales pitch. See you on the next one.